Let's talk about a couple of other stocks that are on the move away from technology, because it's a far bigger market, as you know, than just that. Our chart of the day is Gap, up on strong guidance. We don't have ownership on that, but Costco's in the news today. It had been slightly lower. We can take a look at an intraday of Costco to see if it's turned around after we look at the Gap, which was up quite nicely after this guidance. A week in which Kohl's was a disaster, too. And we hadn't had a chance to talk to Jenny about that yet. There's the Gap reflecting what I'm talking about, up 27%. We can throw up intraday of Costco as well to see what's happening. It's not like the earnings, were bad, and the stock is down about 2.5% as we see. But Kohl's was a disaster. Yeah. We wanted to talk to you about it. What should we think about it from here?
So, okay. I think Kohl's was a disaster in a weird way, similar to the way Dell was a disaster, which is that the expectations were just too great. So you saw Kohl's up 12% for the month before yesterday. And the reason being is people were looking at things like Abercrombie, right, which had wonderful numbers. Then yesterday you had Foot Locker, Burlington, Best Buy. They all had wonderful numbers. They all have a very similar consumer base. So the expectation, me too, was that Kohl's would have a nice quarter based on that. In fact, they didn't. I'm okay with Kohl's. So when you say, what do you do from here? I'm giving it 2 more quarters. And the reason is because if you kind of dive down into what the quarter said, regular sales were actually up 2.4%. Clearance sales knocked the overall down by 6%. I'm okay with that. Their inventories were down 13%. That's really good. And they're expanding their Sephora brand. And they have Tom Kingsbury, who runs the business, who came from Burlington. I think with everything kind of outside of that clearance, I can give it a little bit longer. One other thing that's really important for me as a dividend investor is in the press release, they have like 6 main bullets. And in those main bullets, they said, we intend to continue to return capital to shareholders through the dividend and through debt reduction. So that's why I'm willing to give it time, because I think theoretically, either next quarter or the following should be more like what we've seen from Abercrombie, Gap, Best Buy, Burlington.
So Kohl's is down almost 25%. Year to date. Looks bad until you look at Lulu. Take a look at that chart on a year-to-date basis, because it's down about 40%. I know you own this. The stock reports, or the company reports, earnings next week. Are you concerned at this point? Think you're going to hold on to this name? Give our viewers some knowledge here on how you're thinking about it.
So this was ill-timed. It illustrates the dangers of buying a name that's significantly off its highs in advance of earnings, and then them not disappointing on earnings, but disappointing on the outlook. Mm-hmm. This is a company that has tremendous brand awareness. We think that's going to pay dividends kind of prospectively. But we would be kidding ourselves if we weren't entertaining this as a tax loss sale after they report. Now, the thing that keeps us from doing that is they historically trade at 30 times earnings. It's a significant discount now at 21 times. We bought it at around 27 times earnings. So, I think we got out a little in front of it, but we're not willing to sell it just yet.
It had, I guess you could make the argument that it had always deserved premium, certainly in the apparel space, and it got that massive bump during COVID. The question is, coming out with greater competition from some privately held brands, whether the best days, so to speak, are behind this name simply because the landscape's changed from a post-COVID world and also from a competitive world.
I think the competitive landscape has changed. You talked about it the last time with Viore and the other stocks that we mentioned at that time. There's no doubt there's more competition, but here we are back at levels from a price standpoint that we saw during the COVID lows for this company. So again, if you're going to be a value buyer, you need some type of rotational shift. You need a catalyst. I think we may see some of that coming out of the earnings report. If we don't, we'll likely move on.
Okay.